Hi, this is Rob Beardsley with Lone Star Capital, and I wanted to talk about value-add business plans. But all value adds are not all created equal. So, for example, you can have a value-add business plan where you take a C minus property and take it to a C plus, or you could take a B minus and you could take it to a B plus. You could also take a C plus all the way to a B plus. Harder to do, but those types of things can happen. So when you're evaluating a deal, you always have to look at what is the value add opportunity. Am I simply maintaining the status quo, but just slightly turning things up a notch and commanding maybe slightly like $100 rent premium? Or am I looking to completely transform the asset and reposition it from a C to a B, which is often where the bigger profits are, but it's also a bigger risk. For example, if you're taking a 70s or 80s vintage property that has 8-foot ceilings and you're going to reposition it to a B plus, and your rents are going to be competing with 90s vintage and 2000s vintage properties that have 9-foot ceilings, that's always going to be a losing proposition, and you're putting yourself in a very difficult position there. You have to be conscious of that, and you have to be aware of that, and you want to look at your post-renovated rents and if there's headroom there between your product and the competition or the slightly higher quality finishes in the market. So if you're repositioning to a B, you want to make sure that the B plus A minus rents are above you by $100 or $200 or whatever is appropriate in your particular submarket. And so when I said at the beginning that all value adds aren't created equally, I want to highlight the fact that there's more inherent risk in today's market in trying to take, let's say, 80s or 90s property and value add it to a B plus A minus. That is a very competitive space, and it's starting to compete with newer supply. And all around the country, everywhere you look where there's quality demographics and growth, there's a lot of new supply occurring. And that new supply, as it's coming online, is offering concessions. All that new supply is competing amongst themselves, but then it's also competing against the existing and older product, and that's kind of pushing things down. So the older you are in vintage and the lower your rents are further removed from the new supply, the less that supply shock and competition affects your property down there at the sea level, for example. But the closer and closer that you get to the new supply, the more and more it becomes relevant to you, and the more the negatives associated with supply, such as softening of rents, concessions, hurts you more. So if you're going to take a perfectly good B asset that's just sitting right in the middle and it's got less competition, and then you value add it and you're going to try to have pro forma rents that are on par with A minus property, that's very difficult because now again you're competing with the new supply, which, like I said, there's so much of it in these certain submarkets where there is that strong growth. You really are putting yourself at a disadvantage. Conversely, if you are taking a C minus asset and you're just bringing it up to a C plus, that's a much more compelling business plan, and in my opinion less risky than trying to push something into that A space. And the reason for that is workforce housing and C-class property is supply constrained. They're not making any more of it, and you're not trying to drastically reposition the asset. It's already a C-class asset, and it always will likely be a C-class asset. So the change you're making is not so dramatic, and it may only be a $100 rent bump and be perfectly appropriate, and demographic and the tenants in that area are perfectly capable of paying those rents. This topic is similar to our general thesis of we don't really like taking properties that are performing at the market and then pushing higher and pushing what the market is for that property. What we prefer to do is we like to find properties that are performing below the market, and we're simply closing that gap. So if the market is $1,000 rents for 80s vintage properties and 95% occupancy, we want to buy something that's 85% occupied and has $900 rents, and then we just bring those things up to market, and now we've got a property that's performing right at market. We're not asking the property to do anything abnormal for the market or be particularly special. Yes, we want to, in our performance, actually, to be the best property of its type, and we want to push and squeeze our operations as much as possible. But for the purposes of underwriting, we in a way almost have to underwrite to us being average managers, and that all we can do is just bring the property up to average. And so what we're looking for is deficiencies and trying to find properties that are underperforming. And that is actually pretty tough in today's market, just because there has been such a long and strong bull run, and there's a lot of liquidity out there and a lot of investors chasing deals. So where there is a CapEx need, where there is a need for better management, there's usually capital and managers for that already. So it is really hard to find those true value-add opportunities that have been untouched and that present a real opportunity. There's so many Frankenstein value adds out there that have changed hands 1, 2, 3, 4 times in the last cycle, and each time they were value added in some way, and so they've got all these different renovation finishes. That's why they call them a Frankenstein value add. And so it's always a riskier thing to take on a value add from a seller who's only had the property for a few years, just because that story doesn't stand up as well. So that's just a whole nother topic which we're very conscious of, which is the seller story. I made a video in Miami about that, talking about the importance of the seller's basis in the deal, their business plan, why they're selling, what was their business plan, what did they do to the property, and factoring that all in just to kind of sanity test the deal and see, does this just thematically make sense? So hopefully you enjoyed this discussion about value adds and how they're not all created equal. And in summary, we prefer the value adds that are more so keeping them in the class, so going from C- to C+, or maybe C+ to B, but we try to stay away from value adding something into that A- or A space because it's very competitive there. And we want to always make sure that we're leaving headroom between our post-renovated rents and the top of the market for that property type. Thanks for watching.